All right, we talked about how to maximize the cash value of a life insurance policy and looked at several examples in the past several videos. Now we're going to talk about how to use the money. How do policy loans work? What do I want to be aware of? We're going to touch on several bullet points in this video and then look at several examples in the next video. Let's get on into it. So, several items that come up when it comes to policy loans. Number one, when can I access my money? Naturally, if I'm interested in a policy for cash accumulation, how do I hypergrow that cash value? A common question is, how do I access it? When can I access it? Are there any rules or stipulations I need to be aware of? So, when it comes to policy loans, you can access your money anytime. A couple bullet points to be aware of here. Always good to have the additional information. Is typically companies do like a policyholder to wait 10 days, 10 business days after they make a deposit. So if I throw $50,000 into a PUA deposit and it is there in cash value, the next day, the company, not all companies, but most, want us to wait typically up to 10 business days to turn around and access that money. Really, they want to make sure the funds clear from the bank account, that the payment doesn't bounce or anything like that. They want to make sure that, hey, the money's actually there. But typically, we've got that 10-day wait period. Another thing to mention here is when I read the contract language of a life insurance policy, I've got this to deal with, which scares some people. Remember the first time someone had mentioned it to me, they were reading through the full contract of a life insurance policy and they said, hey, it says right here that the insurance company can hold a loan request up to 6 months. This isn't acceptable. I'm looking to pay in, I think he was looking to pay in $500,000 or $550,000 per year and wants to use that for real estate opportunities. It's like, if I need the money, I don't have to wait 6 months. That's not gonna work. So in the contract language of a life insurance policy, you will see that companies can hold a loan request up to 6 months. With that said, I have not seen that happen going back to policies looking at that existed during the Great Depression, 2008 and the financial recession. So that is in the contract language. Companies have the right to hold our funds for up to 6 months. Really what they're looking for here specifically is when I take a loan request, they want to make sure it's in good order. There are cases of fraud that occur with cash value life insurance. We had it happen once with our office where someone reached out pretending to be someone else, trying to get a policy loan from someone else's account. Fortunately, it was caught, resolved. We were able to catch it, but the insurance company was able to catch it as well. Insurance companies have departments that look out for that. This is why they might hold up a loan request. When I take a policy loan, if they get a signature back that is e-signed, digital signature, does not match with prior signatures of the insured, they're going to look at it and say, hey, before we send this money to you, can you verify that it is you in one way or another? They want that verification. This way, money does not go to someone else unintentionally or intentionally in a case of fraud or anything like that. So really it's there as a protection, but if we're just taking loans, we can access it anytime. Typically, if it's direct deposit and everything's in good order, I've noticed on average it takes anywhere from 2 to 5 business days. Could take up to 10 business days, especially if it's sent via check. If there's an issue where it's sent via mail or the forms weren't in good order or a mistake was made somewhere, that could delay it. But the main point is we can access the money anytime, and it typically is a very smooth process. The one thing to be aware of, in my opinion, is when we make an initial deposit and that credits the cash value, just keep in mind that it will take typically 10 business days for the insurance company to be comfortable loaning that back out if we're in the habit of funding a policy and quickly loaning out, which that's on our preference, depends on our preference really. Tax-free. So when I take out policy loans, that is a tax-free transaction. If the policy is not a MEC, it's also important to be aware of that if I drain the cash value, I've got nothing left in this large loan balance, I could be in a position where I have a large taxable event. We touch on that, or we cover it in detail in our whole life and taxes video, which I would encourage you to watch if you'd like more information on how life insurance policies could result in a taxable event, me accessing my cash value. But Generally, they are tax-free if I don't trigger a MEC, if I don't completely drain it and pay nothing in, I can access it tax-free. Payments are optional. This is very, very attractive to so many people. If I take a loan from a bank or a lender, I have to pay it back on whose terms? The bank or the lender. A lot of people are comfortable with that. Some people hate that. I've talked to so many people over the years. I remember one individual distinctly. He's a physician, does very well, very sharp guy as well, really digs into finance. He wants to understand it. And he says, I hate working with banks. Like, I'm not going to do it anymore. I like these policies because I have control of how and when I repay my loans. Now, the interest rate is a bit high relative to what he can get elsewhere, but he outright states, I don't care. Like, the convenience and control right now with what I can do with those policies today is worth it for me after we present all options and such to him. But payments being optional, where we can pay the loan back like a line of credit without interest-only payments required each month. Now, what I will add in respect to payments is if I have a loan outstanding and I pay nothing back, the interest will be billed on my policy anniversary date. I have the option to pay it. If I do not, the policy will borrow from itself in order to cover the loan interest. And we're going to cover that in detail in the next video when we look at examples of loan interest and not paying anything back. Money continues to compound. So a unique feature to a cash value life insurance policy is that once a dollar passes through the cash value of a life insurance policy, regardless if I just let that dollar sit and grow or if I pull money out, if I borrow against it, I continue to earn dividends and interest on my entire cash value as if I never touched it in the first place. Let's demonstrate this quickly. So if I have a policy earning a dividend rate of 6%, we touched on this in a prior video. If I'm earning a dividend rate of 6%, is that what my policy is actually growing by each year? Meaning if I have $100,000 in cash value and a dividend rate of 6%, will I see that cash value to grow to $106,000? No, that is not the case. Remember that the dividend rate is a gross rate that is credited after the company's insurance expenses and mortality charges. If I have a dividend rate of 6%, that might net out my internal rate of return to call it 4%. Now that is a tax-free yield if I do everything properly, safety, liquidity, all that good stuff, but that is my net IRR. So let's assume I have that cash value of $100,000. If I don't touch it, the dividend credited will be what? 6%, which would net out to that IRR of 4%. Now let's assume I borrow out $50,000. I take a loan. Here we go, $50,000. The loan interest rate we'll assume is 5%. Typically, you'll see loan interest rates range between 5 and 6% with most whole life policies and carriers. Some companies have variable rates as low as 4.5%, but generally they're between 5 and 6%. So that 5% goes where? To the insurance company. Now, I borrowed money out. In respect to that dividend rate of 6%, I am going to earn that on the money remaining in cash value and also the $50,000 outstanding in loans. Now again, the dividend, that's not what I'm earning. So on paper, we see this a lot where one looks at this and says, okay, I can earn 6% and borrow at 5%. I still have a positive 1% spread. The reality of it is I'm earning 4% still on my full $100,000, so the money that's still in cash value and what I loaned out, but I'm earning 4% on the full 100, and in this particular example, paying 5% on the $50,000 outstanding. So on the $50,000 portion, I've got a 1% cost to borrow because right now where loan interest rates are on whole life insurance products relative to what I am actually earning, typically at best it's going to be a wash, but we'll typically see it a little bit negative because of the interest rate environment we are in right now. So with that said, what a lot of people do instead of this is look at this bullet point down here, collateralized line of credit, i.e. a cash value collateral loan, which involves taking my policy to a bank or lender and saying, hey, here's my cash value. I've got $100,000. I'd like to take a $50,000 loan from you, the bank, and I'm going to put up my cash value as collateral in order to receive a loan. So I'm earning the same 4% IRR, which is that 6% dividend. But now, instead of taking a loan from my policy, the insurance company, at 5%, I get, call it 3 to 3.5% from the bank. Some people like that. The disadvantage to that, going back to that physician I mentioned, we mentioned that to him, he didn't like it one bit. He liked the interest rate, but he goes, I'm not dealing with banks. And he stopped it right there, which is perfectly fine. We want to present the option. A lot of real estate investors, a lot of business owners that are used to working with banks say, hey, this is perfectly fine. Like, I've got no problem using my policy as collateral because I normally just have it in cash doing nothing. So now I leverage it in a policy that actually appreciates over time. I can leverage it as a line of credit, obtain a loan that if it is for business purposes through a bank, on their paperwork, I can check off this is a business loan, which can generate a potential tax deduction while I'm earning that 4% IRR and paying 3 to 3.5% tax deductible. Now, all of a sudden, from a spread standpoint, that can make a whole lot more sense. And then if I get tired of working with the bank, I can just borrow from my policy at 5% and pay it off for the control again. So it's an option. Not to say one's better than the other or anything like that, but again, it's an option. It's good to be aware of this kind of stuff. So with loans, the main point here, money continues to compound. The collateral loan is a great option to be aware of when I look at it. Let's progress on. Give ourselves some space here first. There we go. Next, we kind of touched on this. The interest on the loan does go to the insurance company. Just like that example we saw with that 5% loan interest rate, whatever my loan interest rate is on a life insurance policy, that dollar figure goes to the insurance company. I do not pay it back to myself. We see this a lot, or I just want to provide transparency on this topic because when we look at concepts like infinite banking or bank on yourself, a lot of times people come to us and there's a little bit of confusion where they see or hear that, hey, when I take a loan, I heard that I pay the interest back to myself, which is not the case. So to demonstrate this, if we look at the idea of the banking concept, in respect to loans, here's exactly how it works and what it states. That if I am borrowing from a life insurance policy, if I'm taking a loan, and that loan rate is 5%. The idea of the banking concept promotes treat your policy as if it were a bank and charge additional interest to make a profit. So in our own mind, on our own balance sheet, we're charging additional interest. So I take a loan, could be any amount, say it is $100,000. If I just pay back the principal and interest at 5%, 5% interest would go where? Again, to the insurance company. We may see, or we will see these concepts promote pay yourself back additional interest. Let's pay it back at 10%. So what this would entail is I'm now paying back the $100,000 at a 10% repayment rate. And of that 10%, 5% goes to the insurance company. That's their cost to borrow. And then the other 5% is directed to a PUA payment, accelerating the cash value further. So to do this, we would need to build in additional mech space, make sure we've got the premium set up at the proper number to do this, which some people we work with do just this. They say, hey, I want to do exactly what I see and hear out there in terms of treating my policy like a bank, set it up in that manner, and make sure the policy is flexible as well. So you can do it, and then some just say, well, I'll just max the policy out from the get-go, have optimal cash value, and borrow and repay. You can do it really however you want. But to be specific there, this whole idea of the banking concept really involves first paying the insurance company their loan interest and then paying yourself back at a higher interest rate, because if I was borrowing from a bank, an institution, whoever it might be, I'm going to pay them that interest rate, whatever they charge. So now I can do it with my own policy, treat that as the bank, and it really promotes the idea of taking control of your own finances instead of relying on someone else. Hence the term and phrase, be your own bank. So just wanted to be clear on that point, that it really promotes, or what I wanted to touch on, the interest goes to the insurance company, whatever the interest rate is on the policy. Now again, rates are high right now relative to what we can get with outside lenders, which is where we have those cash value collateral loans, and then this idea of IBC and pay yourself interest we just touched on. So what we're going to look at in the next video is we're going to touch on the topic of non-direct and direct recognition, and then look at a number of actual loan scenarios. What's it look like when I borrow from a policy and pay it back? What's it look like if I don't pay it back? If I pay interest only? If I pay myself extra interest? We're going to look at a case study with that. And then also a cash value collateral loan example, which someone we're working with actually wanted to see this firsthand because he was measuring the numbers, and policy loans did not make sense for him based on what he was trying to do. And he was in his late 50s, so that'll be an interesting case study as well. Hope this one helps. Reach out if you have any questions. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.